Simple answer, no.
The most challenging part of your job?
What does it need for you to have peace of mind for the 2 years of runway?
Now is the time that I should push.
You might have to be very persistent.
They all have skeletons in the closet.
Try to understand what the reality of the founder you're backing is.
How do you fix the salary of the founding team?
Let's have that discussion again in the next round.
Then we have another one about the pitch decks, because you must receive a lot of pitch decks. And is there anything in particular, the style, the way that is written, the storytelling, that stands out more than that catches your eye or gets your eye?
So, pitch decks, difficult one. I think, firstly, be conscious of the fact that the average VC receives hundreds and hundreds, and the more senior the VC that you aim to talk to, the more stuff he or she will have going on in any given day, right? So there is the existing portfolio, the new pitches, the events, the internal admin, management of the firm, etc., etc. So it's incredibly important to be concise and to the point, because the attention span will be limited. Also, you might have to be very persistent. The fact that you don't get an answer doesn't mean that you have been ignored or the pitch wasn't valid. It might just mean that the email got lost in the chaos of the inbox. So it doesn't, not every day, but maybe if you don't get an answer in a week, hey, getting it back to the top of your mailbox. So those are just the very basics.
Yeah, there are founders that are very good with this, by the way, with the reminders. Maybe too good.
No, and then there is the point where if you don't get the reaction after a third reminder, then okay, then you shouldn't put your effort on that VC, because there are other VCs that might be interested, and that VC obviously is not interested in what you're saying, or maybe it's not the right person within the firm, or whatever the case might be. So then coming back to the pitch deck itself. So we said it needs to be concise and to the point. To me, a good pitch deck is a pitch deck that gets you interested, but leaves questions that you want to ask, because the pitch deck is just a first way to start the conversation. Now, to put yourself, by the way, at the top of the inbox, it helps if that pitch deck is not completely cold, but comes through some form of a reason why you're reaching out. Either it's a common connection that makes the intro, or you met at the conference and say following up, or whatever the case might be. Obviously, that helps. So going back to the pitch deck itself, I would then always say, A, you are in the venture business, so frame the market as being a very large one. So a $1 billion market, as big as $1 billion might sound, is a very small market, because if you then take the assumption that, okay, that's the global market, and then you're only going to be in Europe, and that's 300 million, then you only win 2% of the market, it becomes very small. So frame the market to start with as a wow effect, but be conscious that the person at the other side of it is not stupid. So if you are pitching, plant-based meats, then the first slide can be, this is a multi-trillion-dollar market because it's the food market. No, you are in the sort of plant-based meat market, so you have to then go that by geo. So make sure that as you drill down in what you actually are doing, that market is big enough. Again, if you're doing vertical SaaS, you can't take the software market as a whole as your market. And you see a lot of that happening. So once you've got the attention of, hey, I'm after something big, then use a slide. The slides don't have to be too condensed with text, but highlight anything that's impressive about your company. So it's extremely powerful to have a slide at the beginning with the key reasons of why you are the perfect case for that VC. Now, let's face it, early VCs want to see growth. So a strong growth metric, whatever the most relevant metric in your company is, it might be a KPI, it might be revenues, it might be downloads, whatever it is, strong growth. Then you want to obviously show that the economics, either already now or at scale, are very attractive. So ultimately, whichever segment you're in, you want to have low acquisition costs and very high lifetime values. And there is no absolute number. So an acquisition cost might be 50 cents or 200,000 euros.
Yeah.
200,000 euros is not necessarily bad if the lifetime is 10 million.
Is the ratio LTV CAC?
It's effectively exactly the ratio you're looking at. And then specific to the company, be conscious that there are a certain number of metrics VCs like to look at. There is the magic number, burn ratio, whatever is most relevant to the space you're in. Try to highlight it and try to be top quartile. Yeah. And you're not going to be top quartile in everything. You're not going to be great in everything. So highlight the things you're good at. That got the attention of the reader. Big market, good metrics within that market. Then go into that product obsession. What am I doing? What problem am I solving? Why is it a big problem? Why is the pain point so big that I'm going to win? And leave the questions then open. So then the recipient knows it's big market, so check. Knows that you are performing well within that market, check. Understands what you're doing and gets excited by what you're doing, check. And then all the questions arise. Well, why are you doing it better than the legacy? How do you fight against these three competitors? This, and that. You can put you should also put a competitive chart, but all these questions remain open, and that starts the dialogue. So it's the pitch deck. The first pitch deck is not self-contained. It's not the end of the story.
Of course.
Then you have the much, much longer pitch deck, which is a DD sort of pitch deck. It might have 50, it might have 100 slides where you go into some do it in a pitch deck, some have 20 separate files in the data room, whatever the case might be. But that's gets relevant when the conversation has initiated, the recipient is interested, you have done a couple of follow-on calls, it's clear who within the company is the sponsor of your deal, and then you start drilling into the nitty-gritties of the company.
Now that you mentioned the competitor landscape, I just kind of hate a little bit when you see this slide and you have the access and then you have Google, Meta, we're here. Why do you tell me this? Like, I like the idea, I like the pitch, and suddenly you do this. It's like, you are not there, and it's okay, you shouldn't be there. Like, yeah, but I like what you said, be realistic.
It's always like that. On the other side, okay, generally, probably startups won't say Google and Meta are my competitors, but it's a bunch of other startups. The reason why VCs want to see that slide is to make sure that you as a founder or founding team are aware of the market, who you are fighting against, and have a good answer on why you're better, why you're going to win, even though some other company is bigger than you. If you're completely unaware and say we are the only ones doing this and it's unique and nobody has done it before, and then the VC, you have to go by assumption they saw at least another 10 companies doing it, it makes for a difficult discussion then.
Yeah. How are you so far? How do you feel? You feel tense? You feel good?
Good.
We have, I think, half of the questions still.
Very good.
But maybe we don't cover it all. We'll see. But do you need anything else? Coffee?
No, I have water. I have tea.
Okay, good. Then this question, I particularly like it. I have my own opinions, of course, but how do you fix the salary of the founding team?
Yeah, that's always a discussion to be had. I think the first point to be made is, and again, let's focus on early. Once you're profitable and everything, then it's a different discussion. But at the early stages, by definition, the founder is entering a path of high risk, high reward.
Mm-hmm.
If things work out, the founding team is going to become incredibly wealthy. And that's sort of the counterbalance to, well, to get that asymmetric return profile, you've got to give something. So founders are fully aware and okay that they're probably going to have very low salaries initially in the bootstrap phase. They're probably going to eat into their own savings. And even when they get funded, they're still going to be below market in terms of the salaries they could earn, because the investor is countering by paying a valuation that at that stage is still too high for a company. So at pre-seed or seed, very early days, the valuations that are given are not valuations at which the company could sell overnight, because the company more often than not doesn't even have revenue. So the company's worth would be kind of zero in a sales situation, but the VC then gives them the 10 million pre-money, 15 million, 20 million. And obviously that's the negotiation of, okay, I'm giving you that upside asymmetric return, but obviously you have to fully commit to this company, and this company won't be the safe job you could have had in
of course,
a big enterprise. Said that, I'm always very conscious that different people have different life circumstances in different geographies also. There are geographies that are way more expensive. There are life circumstances that mean that your needs are higher than another. So a founder in his or her 40s with 3 kids has different needs than a 22-year-old without a family, without kids. So, and not every founder in their 40s is wealthy and can say, well, I can cover all that out of savings. But that doesn't mean that they're not worthy of getting funding. Maybe that's exactly the founder at that point in his or her life, with the experience they have, is the very best person you want to back. So you have to find a setup by which the founder can still fully focus on the company, because it's a bit counterproductive if you say you have to take a very low salary and you have to fully focus on the company, but the founder is not getting to the end of the month because kids need to be, school fees need to be paid, and rent and mortgage and this and that. In those cases, it doesn't mean that you say, okay, just because you're a kid, you're going to earn 5 times as much as if you didn't have. You have to find compromises. And one compromise to me is usually, well, it goes a bit to the dilution topic of saying, let's do something that might be good for the company, for you, and for the investor. You might be allowed to do some secondary.
That was the next question.
So you can say, okay, sure, it means more dilution. But as an investor, I don't see this as opportunistic. I don't see this as you having gotten a high valuation and trying to cash out and de-risking yourself. It's a structured process as part of the funding round and negotiation, where we went through your life needs. We said that, okay, with 135,000 whatever a year, that covers your costs. So we are reverse engineering for that between this series and the next. Okay. So we say, what does it need for you to have peace of mind for the 2 years of runway you have? Let's solve for that. And then let's have the discussion again in the next round, because a lot of things might have changed. So I find that's a conversation that can and should be had, because you want founders that are fully motivated and give their all for the company and are not distracted by 20 other things. There might be extreme cases where you say, okay, maybe a founder position is not the right thing for you for the stage of your life you're at. If you say my fixed costs are 700K a year and I'm doing a pre-seed, well, okay, sure. Then you need to solve it somehow. It can't be solved by the investor. But generally, we are talking about tens of thousands, maybe 100K a year, something that is solved in the grand scheme of things. And I prefer having those discussions rather than then having endless discussions about salary, because then you get back to the point of saying, okay, but you can't have it all. You can have the valuation and the salary and the secondary and.
So rather, then when do you think is the moment to say, okay, let's raise your salary and let's get to something close to the market average? When is the right moment to say, okay, let's do this salary talk?
I think the salary talk can be had as the company grows and as the company either gets more funding or gets profitable. Because once you're self-sustainable, it's one thing. Or if you got a very big funding round and you created value for your existing investors, obviously in a money-losing business, a bump in salary takes away from the resources the company has. So it's always a trade-off. But if you have grown, if you created value for your shareholders, if you have enough cash on balance, by all means, it's a discussion that can be had every time a new business plan gets discussed at the end of the year. Okay, what are the salaries? Are they market to companies at your stage in your country or not? And then those are fairly easy discussions to be had. Going back to what you look in founders, if at first investment you spend more time negotiating on salary than everything else, probably that founder is not that founder with the great vision and fully committed, etc., etc.
I remember actually now, I don't fully remember the details of Elon Musk, but I remember that this was back in 2017 probably, that he said he will have a very low salary, but he would get a huge bonus if the company will get to X amount of revenue, which back then it was with Tesla. Back then it was like, no, of course not. Right? Yeah. Okay, but you sign this and then we'll see. And now he's one of the most...
but now the court is overruling that and they're not giving him the bonus, which is absurd in itself, because the goals he had set for Tesla were in the eyes of everyone so absurd that everyone accepted. Now that everyone made the money and the shareholder value was created, now they're retracting. And by the way, the majority of shareholders re-voted in favor of giving that package back, and the Delaware court is blocking it. And the ones making the most money are the lawyers getting a $350 million fee. So
especially in US.
it's a bit a question of, okay, how is, as much as, okay, you say the richest man in the world doesn't really need another 56 billion. Well, that's not the point of the discussion.
Yeah, totally. As a rule of thumb, by the way, you mentioned an amount, 135K for a CEO in Germany, in a company that is growing, that is not yet a bit positive and something like that. That would, just to take as a rule of thumb.
No, I was just saying amounts that can be, I was just talking in terms of your life circumstances. If you might need 50K, you might need 100K. Those are numbers that can be talked about. If you say I need 700K, I need $1 million a year, those are obviously numbers that don't work.
But you would be open, as you said, if it makes sense, tell me your life cost, we can manage to get to some agreement, and that's it. Also, like
it's a decision that the VC has to take. I think ultimately you can take the hard road and saying these are the salaries, and that's market. And yes, it's under market compared to if you were working at Google, but you have 20% equity in your company, and the equity is now worth $5 million. So don't complain and do.
Yeah.
I always say I like to understand what the life situation and circumstances of my founders are, because the last thing I want is them starting to spend half their time trying to find a solution on how to cover their kids' school fees.
Totally.
I'm not saying we are an ATM and you come and say, my school has this many fees, pay them for me. I'm just saying, before you enter that journey together, try to understand what the reality of the founder you're backing is, so that you can structure the best structure for both the founder as well as you as the investor, and have a very healthy, good start to that relationship, so that you know that you're fully committed, both of you, and that you set up a framework that works for all.
In order for you to have control and to have the right idea of your founders and the new companies, what do you think is a good ratio for a fund manager of new deals and companies being managed by you as well?
Different funds have different models. It all depends on how active you strive to be in any single portfolio company. I think you can make it work having 100 portfolio companies, or you can be completely underwater having 5 portfolio companies. HV as such is a very actively involved company, not operationally, obviously, but we like to be there for our founders. We like to be accessible 24/7. We like to help where we can. The expectation of a founder should be that if I call or write an email to HV, I receive an email back or a call at the same day. Maybe I'm in a meeting, but as soon as I'm out of the meeting, I call you. The expectation should be that if you say, these are the 5 topics I'm struggling with, that me as your portfolio manager or the fund looks into, is there anything we can help? If not, are there contacts we can make? And if that's the expectation that the founder should have of us, that means that we have to commit to a certain time commitment, meaning that there are only so many portfolio companies you can have. I think somewhere between 7 and 10 where you're active feels about right. Personally, I try to structure my portfolio to have them across stages, so that as some of my early stage bets grow into later stage companies that need way less attention, then I can start adding more very early stage companies that need a lot of attention, and the middle of the curve needs a little bit, and then you kind of, so it doesn't mean that all 10 all day long are calling me. Out of the 10, there might be 3-4 that we only speak at the board meeting because there is nothing to be done, and there are some where we might speak daily.
Got it. I can tell besides this that actually you're very fast responding. I don't know how you manage and what's the trick, but you're like a founder that is really into, you respond very fast, which is really appreciated. Let's go now to a different thing, that is, could you pre-sign to get out at a certain time of a company? Example, you sign a pre-seed deal, and then you said, I'm going to get out at Series A, or when the first institutional investor comes in or something like that, even if the company still needs the money?
Simple answer, no. Because to get out, you need a buyer. And by definition, if it's a private company, there is no stock exchange to sell your stocks in. There are, however, things that go in that direction. You could say, I'm not investing equity, I give you a loan. Obviously, that's one way.
That,
So you can structure a convertible note in a way that it has some of the equity upside, but still it has an ending in time. So you say in 24 months, you have to repay with this much interest and this much upside. So you can build in some upside that's equity-like. Sure, you can do that. And there are plenty of structures like that. Or you can make sure that in the contracts, there is nothing stopping you from being able to selling your shares. That doesn't mean you have a way out. It means, however, that if you find a buyer, then you're allowed to sell shares. Now, a lot of contracts early on would stop you from doing that because obviously founding team and investors don't want people running around trying to sell shares in the company at whatever valuation. The founding team has to have a control over what's going on. And if the shares are trading at different valuations, maybe at a big discount, that's a net negative for the founders fundraise. So difficult conversation to be had, probably not the right investor for a startup. But again, if that's what the investor wants, then a debt-like structure is the way to go and not equity.
Got it. Very clear. Generic one, what's your take on ESOPs? And when, why, how, who?
I mean, it's a very generic question. So they are good and they should be there now, giving a bit of color on that. As a startup, when you start, you have to attract people, great people to come and join your journey. The reality is that most probably you won't be able to offer highly attractive salaries to the very best people that have offers left, right, and center. At the very junior level, it's people that get their first job and they're happy. But at the senior level, your salaries are not going to be attractive. So the thing that you can pitch to make it very attractive, and that you should, is we are co-owners of this company. Now, obviously, you're not the founder. You're coming at a later stage, and I already raised some money, and I already achieved a lot. But you are going to get a cut, and let's face it, 0.5%, 1%, 0.3% can be very big numbers if we succeed. So an ESOP is absolutely mission critical, in my opinion, to the success of startups. A startup that doesn't have anyone that feels like an owner probably will struggle, because then what's the incentive of people to really give it their all at the sub-market salary? You probably will have some negative selection in only being able to attract the ones that are desperate for a job, and they take the job and they keep looking, and as soon as they get a job at market salary, they leave because there is no emotional attachment to the company. At later stages, an ESOP can be used to potentially fix issues in the cap table. So you might have situations where founder performed incredibly well, but the company was struggling in the early stages. There was a ton of dilution in the early stages, and then the founder is left with very little, and yet it rose from the ashes. It's now performing incredibly well. You have good visibility that he or she is going to keep performing well, but then incentive package is out of whack. So you might set up an ESOP to say, okay, let's re-up the founding team. They got punished in the past because of underperformance, but now they get rewarded for overperformance.
So in that case, even the initiative will come from the investors.
Yeah, it's often driven by a new round. So a new investor comes in, says, hey, great company, they're doing really well. I'm willing to put a lot of money at a high valuation, but I want to be absolutely certain that the founding team is committed, and I don't think they'll be fully committed if that's how little they have. So existing investors, before we put the new money, you have to create an ESOP and reward them so that it's a clean cap table. So
makes sense.
There are often discussions like that.
It's always nicer to get in the round as a full lead investor, making these options and happen.
Well, I mean, the cost of that option is that you're obviously paying a valuation that generates value for the existing shareholders. Yep. So the new investor says, okay, we can do two things. I can put a way lower valuation, and then I pay into the ESOP, or I pay a way higher valuation. You're all making money, but some of that money has to go back in the form of an ESOP to the founder. Yeah. So it's just a mathematical sort of shifting of the value.
Yeah. When should you let go of a company?
I mean, from a VC perspective, there is obviously the cycle of you fund the team, then there's a business plan, you try to achieve it, you might miss it, and then you sit with the founder and rework and see what works, and maybe you give more funding, etc., etc. But going back to that example earlier on of the what should you do if a company is stuck at $1 million ARR for 4 years, there might be a point in time where everyone at the table agrees that, okay, this is not going to be a high growth company. If it's profitable or break even, we might end up in that situation where we say, well, if it's not sellable, founders, do you want to continue it? If it's unprofitable, you might get to the point where you say, okay, there is no more funding for this company. Yeah. So let's make this as clean as possible. Let's make sure we don't disrupt the lives of the employees. Let's make sure that we take that decision early enough so that everyone has time to sort of find what they need to do with their life and have enough time to find a new job, etc. Because ultimately we also have a responsibility to, a moral responsibility at least to the team that has worked hard to try to achieve something that would have profited for the VC, for the founders, for everyone. So I think it's always important to have that discussion early enough, give very, very open signals to the founders, say, okay, there is no more funding.
Yeah.
So let's decide what to do.
Yeah, I feel that the line, or that the blurred line in this case, is you really need to have a deep knowledge on the company to be able to say, now is the time that I should push because I'm an investor, and investors needs to be there because we are not bank employees, we're investors, and therefore we need to back the company now that they're struggling, rather than I'm just paying already your lifestyle company that makes no sense to me because the capital is not being used. So I think that is this line, when are you becoming too comfortable and not doing anything for your company, and when it's like they're struggling but they can.
Well, we are always on top of things, and we have we monitor monthly with companies that are struggling. It might be weekly, and indeed, more companies get to a point where they're struggling than not.
Yeah,
pretty much every success story we had a point at which they were struggling, and there might have been a very difficult round, a round that optimally we wouldn't want to have done because it was very high risk, etc., etc. But indeed, those are the difficulties we are faced on a daily basis. But is this a company that is struggling but is almost finished developing the great product we were all betting on, or is this a company that has been struggling because for past 3-4 years nothing has happened?
Yeah. But I think this message is also relevant for the early startup companies. That is, they all have skeletons in the closet. Like almost everyone, like in the case, yes, they all struggle at some point. Most of the companies I know, and probably, they all at some point were like, oof, we're so tight.
It's incredibly difficult.
Okay, I don't want to hold you here forever. It's more than an hour already. I would do 3-4 more questions, and
Let's do it.
You're always you have the. I allow you, of course,
to leave
anytime, but otherwise, this is going to be a kidnapping already. So, who do I include in the board, and what do I let them vote on?
Yes, the board discussion, I think we could do a whole episode only on that. Totally. And there are plenty policies that have been made on boards. I think at the early stages, whether you like it or not, the board will be the investors that came on board. So obviously in the very early stages, an early investor comes in, says, okay, for governance purposes, I need some board's representation. Now, the risk, and one thing that happens very often, is that it never gets course corrected. So at every funding round, a new investor comes in, new investor comes in, a new investor comes in, and you end up in year 5, 6 with 6 investors and 1 founder on the board, and maybe investors that were there from the pre-seed, meaning that you only have people that, while in their position as a board member, obviously have the fiduciary duty towards the company and need to represent the best interests of the company, they have another hat that is defending the investment of the fund they are representing. So they might not do that in the board, but still it's the same person.
Yeah.
And all at once you have boards that are very much skewed to the financial, the exit, the sort of purely economical metrics of your company, and might not challenge you as much on the other topics. So I think if you manage to pull it off as a founder, if you can time constrain any board presence and link it to something, and then, okay, if you keep investing at least XYZ and you keep your seats, if you manage structures like that, it's much healthier because you get your most relevant investors on to stay on board, but B, you free up seats to eventually add external board members that might be industry experts, that might be some expert in something that you're struggling with, in rotational seats where those board seats are not named forever, but they are paid seats, and they don't have a vested interest per se in the company. So they come in, and maybe you move from a board of cheerleaders because all the investors invest in you, so they drink their own Kool-Aid, to 2-3 members that really challenge you hard, make the board uncomfortable, but make you grow. And I'm not saying investors are useless. They obviously, once they invest in you, especially the bigger ones, they have a platform, they have value add teams. There's a lot that investors do for you, but most of that stuff they'll do outside of the board. You call them, you say, I need help in recruiting, and they help you. The boards tend to become a bit superficial reporting meetings, if that's the board you have, because every investor knows you well. They have helped you outside the board, and then you meet once every 2 months and report the numbers. And that's not what boards should be. Boards should be a setup where problems are handled, where founders are challenged, where experts tell you these are the risks that are facing you. The discussion should be far more strategic than just parroting your last 3 months financial reports.
Yeah, I hate that part in the public companies when the CFO takes over and start telling the numbers. It's like, don't do this in here as well.
But in a public company, at least there is value in that a lot of shareholders don't know the numbers. In a board setting, in a private company, you receive the numbers, so you should know the numbers. So then it just becomes a repetition of what you know.
Totally. Until what point, and this is a question I also had myself, until what point do I need to verify the information that I see in the pitch, in the data room, etc.? Like, should I even go to the bank account, check who's paying what, etc.? Until what point do I need to do that due diligence?
So, again, you'll find different funds acting very differently. We take the job of, the trust that LPs give in us very seriously. So we say there needs to be a sanity check that what we're investing in is legit, is true, that the material shared is correct, especially backwards looking. Forward-looking business plans, we are part of the process, but the money on the bank, there is no debt in the company, etc., etc. And for us, the way to do that is to take external providers. You have an accounting firm that looks into the accounts, looks into the actual bank accounts, etc., to make sure that everything is clean. Maybe tax legal advisor that looks whether the structure of the company is clean, that there are no hidden shareholders, that everything has been set up correctly. Sometimes founders, without knowing, might have set up the company incorrectly for what they're doing, and it might lead to a very big tax liability later on. So try to make sure that the setup is clean. We do that. We are a larger fund. We have the means to do that. I don't think every angel or small fund has the means to do that. There is the other side of the equation that says, well, we're in a business that is so skewed towards outliers that, quite frankly, it doesn't matter as much. All that matters is that you were in the outliers. And you can do all the due diligence in the world, but if you hit that company that's at the 10 billion plus exit and you have a good shareholding, then the rest of the portfolio becomes a bit meaningless in the total grand scheme of things of the return of your fund.
Yeah.
I have a bit of as true as it is, the outliers also aren't as many as we know. So funds, to me, that's a bit a shortcut, because then, let's face it, most funds end up without outliers. And then if you also didn't do your work and you end up with a lot of problem cases, then you have a very bad fund. If you end up with no outliers, but everything you have is clean and maybe gets to a 2-3x, you might still have a good fund, even without the outlier.
Yeah. I think that these differences, or that also impacts a lot the role that you have in the round if you're a lead investor.
Of course, it's only the lead investor. I mean, the lead investor should do that work. You can't have every investor do that work. I mean, founder would go crazy.
It would be exhausting, We get to the 2 last questions.
Let's go.
So just the first one is very clear, but actually I've received this question also privately and public. That is, what's the most challenging part of your job?
I find my job, I find myself in a very privileged position. I love my job. I have great fun in my job. So as stressful as it is, I always frame it into a positive aspect of, hey, I like my job. So sure, it's stressful, but who cares? I mean, most people are stressed and hate their jobs. So
good point.
It's a very privileged position to be in. But to answer your question, whether you like it or not, it's a 24/7 job. Yeah. So it's not a 9 to 6 office job. You can leave at 4 p.m., but if a founder calls you at 8 p.m., you should answer. If you have a founder in a different time zone, you should take that call at midnight. So it's 24/7. It can be very emotionally draining in that you will always have a wide range of sort of situations, and you'll always have the very negative, very stressful ones. Or you might have years, let's say 22, 23, where no matter what stage you're at, you had to cut costs and you had to cut employees. So all you did for a year and a half was take calls with founders that were very beaten down, that had to fire a lot of people they liked. And you have to be in a position that allows you to suck away the negativity for the founder, give a positive sort of perspective to how things are going to keep going, and then go into the next call and not go into the next call already with beaten down, but go positive, and again, suck the negativity out and give positivity back. And do that on repeat for over a year. And that's
hard.
Obviously also hard, but it's part of the job, and you have to be able to distance yourself to the point that you say, I'm aware that these times will happen, and if I get completely brought down by it, then it's a vicious circle, because the founder is negative. If his investor is negative, then it's a recipe for disaster.
Yeah, but then how would you recover that energy? And how do you disconnect if you have to be 24/7 up?
Well, you have to sort of, once you've been around for long enough, you have to put in perspective of this economic cycles, and there are down times and there are up times, and greed always prevails, and there is the next up cycle. And you have to put into the context of what's going on and how you're not the only one with this problem, and there is enough use cases that showed how to get out of situations like that. And tough times are tough times. They're not called tough times just because it's going to be tough. It's going to be tough emotionally. It's going to be tough financially. You have to sort of adjust what you're doing, but you have to put it into the perspective of, yeah, you're going to have those times, and you're going to have the good years. Don't get too high on the good years. Don't get too low on the low years. That's your job as a professional portfolio and money manager.
I thought you could have said something like Dave Goggins, that I'm resting when I'm in the shower, or I'm resting to take little naps, not naps, but little rests in between daily tasks.
I think it's emotionally draining, but again, you put in the context of, do you like what you're doing?
Yeah, of course.
And it's easier once you have been many years in the job than if obviously that was your first year in VC, and you are 5 years into your professional career, it might be more difficult.
Yeah, totally.
To manage.
Totally.
If you're 20 years in,
you already found your way. So last question, and thank you again for being so open and so generous to come here and ask all these questions. And the last one is kind of a personal one as well. And this says, what are your underlying values as a human being?
Maybe let's focusing on the business setting, and I think it's of utmost important that respect and support are underlying values. So you could, depending on
I think the question was in that direction.
On the time of the world. I mean, sitting at the source of capital maybe in a time where capital is scarce, it's easy to create hubris and create, well, I'm the kingmaker and I'm giving you capital, so create that sort of arrogance, and you can do it once, and then your reputation is in the dumps. I think you have to be conscious of the fact that the job founders are doing is amongst the hardest you can do. It's incredibly stressful. Yeah. Mistakes are going to be made. You have to respect the other side. Always keep an eye-to-eye relationship. Work towards that common goal while being empathic of the fact of the struggle they might be going through, because it's overwhelming. Everyone wants something from them. The investor says, why didn't you send the reporting? The customer says, why didn't you ship in the product, etc., etc.
The team.
And be supportive. So ultimately, the sort of support that a teammate would give. And there are plenty, again, podcasts about family versus team. You're not a family. It's not unconditional support, but you are a high-performing team. So it's, as long as both sides are high-performing, that support should be unquestioned and always there. But that doesn't mean that's unconditional. So there might be cases where an individual falls short of professional standards, falls short of motivation, of performance, and it's totally fine to address that situation still with respect. But those tough discussions should be had. And if you manage to create that rapport with all your founders and let the founders know that you're there for them in good or bad times, there is no hard feelings in bad times. That's the name of the game. But we'll try to wrap up the bad times also positively. And companies do go bust, but if we come out of that with a good relationship, because we did everything we could and it was in our control, that's the best you can hope for an investor on your board, and that's the best you can hope for as an investor if founders perceive you positively, even in the situations that were tough, even when you were the tough one. If ex-post, they say, okay, we understand, and you treated us
totally
well, then I think you're going to be in a very good position as we see in the overall ecosystem, which, let's face it, is a small ecosystem.
It's a small ecosystem, and the game is long. The game is not one game.
Yeah.
But we're done.
Yeah.
I'm sure going to cut this in 2 pieces.
Fantastic. Yeah.
Is there anything else that you want to say that you haven't said?
No, I think we'll leave that for the next episode, whatever that thing might be.
December 2025.
Exactly.
Okay, so thanks a lot again. It's been a pleasure and an honor to have you
Thanks
here.
for having me on the show.
That's all.
Have a good one.
Thank you, guys.
Bye.